Well, welcome back. Thank you for making it back. And sorry again, we did cut your break a little bit short. We have now two panels back to back, so this is where the marathon definitely comes into. The first one may be a bit of a tricky one. The first one is trying to combine two concepts which are definitely to do with trust, and that is economics of mutuality and investments. And we are still in the midst of trying to overcome the financial crisis 2009, and I mentioned Lehman Brothers already. I won't mention Lehman Brothers again, but then I did. That is one thing. The other thing is, of course, that the financial world is trying to overcome that lack of trust. Did anybody see, by the way, the film The Big Short? Yes, great film, huh? Really, really great film, really showing what was going on there. And, you know, the mutuality thing over the past, yesterday and today, we saw it's quite easy to feel good, to think, okay, I've got a fair banana. And me as a consumer, you as a consumer, you feel good. It's quite easy to have that mutuality concept there, or a T-shirt, which is not done in a sweatshirt. But what about our investments? What about our money, hard-earned? The concept that we can actually invest and do good at the same time, investing into companies that have this kind of mutuality vision, you go, no, maybe not. Because let's face it, bank bashing, yes, absolutely, the system failed. But who were the investors? Me, you. We were all in there. So it really is kind of a participation there as well. So from that point of view, it's going to be a bit of a tricky one. But if you think about the performance, I can only draw up one thing, and it was Clara Miller giving me this fantastic research from Morgan Stanley, giving me the MSCI 400 social index. And that is fantastic. That they see performance in companies which look at sustainable business model and make that the heart, the nuts and bolts of their business. And comparing the study from 1990 to 2014, every year, 45 basis points outperformance to the S&P 500. Sorry, I'm being a bit technical, but I'm trying to make a point. That's nothing, you say. Why should I invest in that index? But on a cumulative basis, the outperformance was 102% versus the S&P 500. So, doing good does pay for the companies as well as for the investor. To discuss a little bit how the entire concept should work in future, especially, we have again an excellent set of panels. And I'm going to start calling up, God, how are you going to come out there? Bertrand, Badré, he's the chairman and founder of BlueOrange. And he finances sustainable developments. That's his business. He's been in the private sector, he's been in the public sector, he worked for the World Bank. An institution that definitely also has issues perhaps with the trust. Would you mind standing with me? Don't walk away. You can tell he wasn't there at the beginning of the last panel. That's fine. That's fine. And you.
That's not doing good.
That's not And you were also, with President Chirac, you were one of his deputies in Africa, which I thought was very, very interesting, trying to see what you could do, as a government representative in order to eradicate poverty down there. Tell me, what do you actually think about the mutuality in the investment business and in the entire dichotomy, if there is?
I think we are at a very interesting moment in time where, as you rightly said, the financial crisis is not over, and we still feel the consequences not only in our wallet but also in our mind. So most people have realized that the financial system did not really work as expected. 15 years ago, we thought we had found the recipe. An everlasting prosperity, blue sky, everything was great, and suddenly the whole thing collapsed. And we're still wondering what comes next. And again, it's still something that we are thinking. At the same time, you still also have the temptation to go back to the good old days. Look at what's going on in the US, where they say, oh, Dodd-Frank, we should deregulate, etc. This is back. And we still have not thought what comes next. So I think we really need to focus on building this new financial ecosystem, but in parallel, all this reasoning around economics of mutuality, and there are other type of people thinking along the same lines. And I think we should really converge the financial reasoning and I would say the business or corporate reasoning, and to really define what is it that we want as an economy for the world.
And how
again, it's not given.
Yes.
It's not given because, again, the temptation is very strong.
Yes.
It's very strong. It's nice to be between us and say, oh, let's do great things, etc. But, I mean, even if it's a revolution, even if it's moving forward, it's still quite silent, and it can be stopped anytime. And one of the very point which I've made in many, many circumstances is that we are at a moment where interest rates are exceptionally low. I mean, less negative than they were a year ago, but still. So when you are in this environment and when you are an investor, you are forced to think and say, okay, can I stay with 0 rate or 1% rate forever if I'm a pension fund or life insurer? The answer is no. So it's a moment where you can force these people to say, okay, maybe you should think differently. And maybe there is a way to make more money in a smart manner. And that's the moment where people are tempted to take risks. Let's imagine that the US Treasury go back to 5 or 6%. This is over. It's so easy to buy US Treasury and they forget. So I think we shouldn't miss that opportunity. We should really move forward and establish this ecosystem now, not in 5 or 10 years.
And how do you do that with your particular company?
Oh, that's a very tiny contribution to this big change. But it comes from the ideas that I've developed when I was at the World Bank. We had this big sequence in 2015 that you might remember, which culminated in Paris with COP21. But before that, we had the endorsement by the UN of the Sustainable Development Goals. So I know that for many people, this kind of big conference are just, nice things on TV and doesn't mean anything. But at the end of the day, all our presidents and heads of state have signed it. So whether you like it or not, you are part of it. So we all committed to make the world a better place. We all committed to eradicate poverty. We all committed to change climate. But we all know that it's costing a lot of money, trillions. I mean, whatever the estimates, we need additional trillions per annum. And I like to raise a question. Do you know what is a global GDP?
Who knows?
Come on, in Oxford.
It's a business school. It's a business school.
Okay, I will go fast in the interest of time. We have roughly $100 trillion is a global GDP. You know how much public money is transferred every year from the north to the south? 140 billion. That's the order of magnitude. So you will not change.
So there's a lot of scope. That's what you're trying to say.
My point is that you have billions on the one end and trillions on the other end. And so the report I did was called From Billions to Trillions. And to get there, I mean, where are the trillions? They are with pension funds, life insurance, asset managers, etc. And this is not their money, as I say, as you rightly said. This is our money. And I remember I met with one of the largest asset managers, and he said, Bertrand, I don't buy into your stuff, impact, mutuality, I don't care. But my clients care, so let's discuss.
Yes.
But
that's great. At least he's open to his clients.
I don't care whether he's a reborn investor or whatever.
Yes.
I'm very happy that he comes and says, okay, I don't care, but my clients care. So you are the clients. You are the people who should tell you guys, make good with my money.
Exactly. Wonderful. Thank you very much, Bertrand. Please have a seat. Thank you. Okay, the next one I would like to call on stage is Mike Bontrager. Where are you? There you are. He comes over from the US. He's the CEO of Chatham Financial and, doing the research on you, on everybody, huh? With all due respect, was fantastically fun. It was really, really good. And one of the things I absolutely loved, somebody commented on you saying you are spiritually devoted, the most spiritually devoted capitalist. Wow, that's the concept. They ever met. What do you say to somebody that says that about you? Would you agree?
Well,
do you feel proud?
I didn't see that quote. So, well, I think I am very passionate. I am very passionate about making a difference in the markets that we serve. Chatham is in the financial derivatives market. We represent real estate firms, private equity funds, multinational corporations in the area of interest rate, currency, and commodity risk. And for a lot of those companies, they're at a kind of a knowledge disadvantage to a lot of the counterparty banks. And so what we do is we represent them through the process. And what I think we've become passionate about is just fairness. Fairness in the markets and saying, how do we trust? I mean, we all know there's a huge gap in society huge trust gap between society and finance.
Especially now.
Yes, especially now. And after The Big Short, and the movie The Big Short, obviously we're in financial derivatives, so we are like in the eye of that storm. So the question is, how do we as a company step into that and actually really help the industry to increase in the trust metrics, so to speak, for the industry.
Now, where did this change of approach come from? Because, I mean, I started in the derivatives business, and the idea of derivatives is fantastic. You're trying to hedge against risk.
Yes.
That is the use side of derivatives. And then you have the abuse side, which led us to perhaps where we are, and that is the speculative part. So when did you actually, pull the plug and said, no, risk management is important, and there is a, long way to go about it, but a good way?
There was an incident that happened early on. Chatham's been around for about 26 years, but in probably the first 5 or 6 years, I remember just as we were starting, we're this really small company, and I was at a real estate conference, and I was talking to one of my clients, the CFO of a REIT, an American REIT, and so we're having a good discussion. We've had a good relationship, and in walks his investment banker, and this is the person who had taken him public, had done all his debt, and they first of all talked about the golf outing they had just gone on the last week. They were yucking it up there, and then they were talking about going duck hunting. I don't golf, I don't duck hunt. And so,
you felt cut out, okay.
And so they're talking, and I'm thinking, because I represent this REIT to their bank's derivatives group, so I'm thinking, okay, let me just be sensitive. That relationship I want to understand. He walked away, the investment banker walked away, and my client turned to me and said, I wouldn't trust that guy as far as I could throw him. And I was stunned because, here, everything relationships-wise said this is really a good relationship. Now, the point here is not that you should not trust your investment bankers. Some you can, some you can't.
But with the golfing, it's a different thing.
But what it did is it said, you know what? I realized then, I just said, our product is trust. Derivatives, advice, technology, all of those other things are merely the delivery mechanism of our true product, which is trust. And from that time, we just said, we are going to trust maximize, not profit maximize. So the question is, in all relationships, how do we actually maximize the trust over long periods of time, rather than say, how do we just
make money?
Make money.
Great. Thank you so much, Mike. Please have a seat. Last but certainly not least, we do have Gabriel Schulze here with us. He's a founder and executive chairman, Schulze Global Investments. Now, and Gabriel, you say that investing into brick markets. I put on my high heels. Okay, now I'm humble. Okay, investing into bricks is definitely yesterday's stories. And you have to be tall and bold to do what Gabriel does. He is what you would call a frontier market investor.
That's right.
What is a frontier market investor?
So what we sort of discovered a number of years ago was that there's a tremendous amount of growth happening outside of places like this, outside of the US, where I'm from. Actually, most of the growth is outside of the developed markets. But a lot of the emerging markets, the BRICS that you mentioned, that story is a little bit plateaued, you might say. There's still things happening. Those markets still have opportunity, but actually the biggest, I would say, the biggest overlooked investment opportunity for anyone looking for growth is the frontier markets. This is where the demographics look great. It's where the GDP numbers look great. It's where the future consumers are going to be. And, interestingly enough, it's the place that investors can have the biggest impact because these economies need capital. Capital's the fuel for growth, the fuel for development, for job creation, for everything that the people of these countries aspire to. And yet investors, by and large, just fly over these places and think, isn't that strange? I'll send a check, I'll do some charity, I'll help out some poor kids down in that country as I fly over it, but God forbid I ever invest there. It doesn't make sense, financially or impact-wise.
And just to define, Gabriel is in markets like Mongolia, Georgia, North Korea, and
Ethiopia. Yes.
And so I wonder, private equity, because that is something we need to also distinguish. You are in the private equity business, so he actually goes out there buying companies, doing to them your magic, and to its entire ecosystem, and then selling them off for profit. And actually not only a profit, but a premium?
Well, look, one of the reasons I think it's so important to be here with these gentlemen talking about these issues is we need to change the paradigm on investment when it's put in the same sentence or the same room with things like economics mutuality or impact investing. Because I've found over the past 10 years as I've built this business, as soon as you say impact, as soon as you say doing good, as soon as you say mutuality, whoever's sitting across the table thinks, oh, yep, the profits just went down, the returns just went down. I guess this isn't about making money. Let's go hug a tree and we'll feel better. That's not true at all. And I think all of us here, are part of hopefully changing that paradigm so that we start to think about impact investing as investing. We start to think about the idea of mutuality in business as business. And in fact, not only does it not take away from financial returns, we found that you get better value. Your companies are worth more when you've taken care of your employees, when you've taken care of the environment, when you've looked at those other sources of capital that we've been learning about the past day and a half. Actually, you get better returns. And that's the paradigm I think that needs to shift, both in business, but also particularly among those who are allocating capital as investors.
And we'll get into more details in just a minute, please, Gabriel. Thank you. Bertrand, let me start with you and trying to bridge what Gabriel just said, and that is that you had experience in Africa, being a delegate, being with the World Bank. You are out there as well in these kind of markets. What you did back then and what the institutions like the World Bank and the French government also do out there, would you say it's comparable to what Gabriel just talked about, where you really make a difference long-term to entire communities?
Well, I don't think it's comparable, but it should be complementary. That's my point regarding the relative weight of the global GDP and public efforts. You need that public money, but it's not enough. And public money on top of that is scarcer and scarcer these days for all the fiscal stress we know, etc. It's unlikely that this 140 billion I mentioned will double or triple, in particular with that administration in the US, in the near future. So the point is, how do you make the best out of this precious public money to attract the money that is searching for value and impact? That's really what is needed. And it's very difficult. We shouldn't fool ourselves. I've heard in so many conferences, G7, G20, etc., oh, let's do public-private cooperation. Let's do public-private partnerships. It's so great. This is a new silver bullet. But it's very difficult. I mean, the truth is public people and private people don't think the same. They don't have exactly the same objectives. They don't have the same culture. And they suspect each other. I mean, if you question, I'm pretty sure if you question the 193 countries of the UN, in the vast majority of the country, if you ask the public people, they say, oh no, the private people, these guys, they want the reward without taking the risk. They just need our money to guarantee potential losses. Yeah. And if you do the reverse poll, oh, the public people, they are corrupt, they are slow, they are conservative, they lack innovation. So we have to bridge that gap. And for me, it's very important to train the people, to address the cultural gap and not to ignore it. I'm very nervous when I see people pushing for this kind of public-private cooperation without understanding the consequences. It can be very, very painful if you wake up in 10 years and you've done the bad things. So I think it's absolutely necessary that we work together, that we partner, but in a genuine manner, understanding each other and putting yourself in the shoes of others. I hated when I've seen public institutions say, okay, I need money, I will ask the private sector. Mm-hmm. And they will just foot the bill. It doesn't work this way. You have to be at the table at the beginning and say, okay, what can you do? What can I do? It's much more difficult than it seems.
Now, saying that trying to bridge the different values and different approaches isn't exactly then having a model of economics of mutuality.
Correct.
The launch pad to say, okay, guys, if you're aligned with this, then we can have a potential fruitful relationship.
Yeah. So you need to have this dialogue up front and say, what is it that we want to achieve? Let's say we want to provide good access to water in that country. We want to discuss the cocoa value chain in that country, etc. And what can everybody bring around the table? The government has a role. The local authorities have a role. The private sector has a role. The investors have a role. The local banks, everybody. And that's really a true mutuality, not one leading the pack and ordering the others to complement. That doesn't work anymore.
So, Mike, everybody's accountable in the process.
Correct, yes.
Yeah. Yes, but
I was, excuse me, I was just going to say that, certainly in finance, and we're in a very narrow space, not not
Yes.
very macro like you guys, but we're in a very narrow space. But as we think, even one of our purposes is just impacting our clients, and how we actually do that in really what is a mutual way. The former CEO of one of the big banks famously said, "We're long-term greedy." And while I would say that's better than being short-term greedy, it's still looking at your client as one big net present value calculation. And it's still maximizing what you can extract from that client. And that's not mutual. And really, we take an approach that says, no, we want to partner for mutual success. We use those words. We want to partner for mutual success. We're a for-profit company. It's got to work for us. But we really say, how do we both be successful companies? And how do we do that well over the long run?
And how many other peers do you actually see in the marketplace that are so open to that concept?
Not many. We are working to try to pull companies together that are in the financial markets that are thinking this way. We're trying to convene some different financial firms because we believe these concepts need to coalesce. We need to kind of figure out what does this mean for a very specific area of finance. It's tough, and I think we're at maybe the introduction or maybe chapter 1 of what's a 10 or 20 chapter book.
Gabriel, I mean, listening to to these comments, the main thing that stuck out to me, what Bertrand said, was relationships. And relationships wherever you are absolutely fundamental because cultural differences, distrust, what is corrupt to me is totally okay with you, and vice versa. And just the fundamental values is very important. So partnerships are key. How do you actually go out there on a normal business acquisition trail before you then go to the roadshow to your potential investors and find these partnerships?
Yeah, well, look, I think one thing that, of course, brings up is the idea of social capital. And what's interesting to me is that if you're investing in these type of markets, if you're investing in frontier markets in particular, you can't ignore the social capital dynamic. Well, I suppose you can ignore it, but then you'll probably fail in your investment. I think actually to be successful, you have to understand that the economy in a developing market in particular is so deeply intertwined with the social, let's say, capital of that particular community and even country. The cultural norms, the particular background and history, all of that plays so heavily into the development that's taking place in these countries' economies. If you don't understand that, and if you don't address that proactively, you won't have success on the financial side in the long run. And I think that's where, again, the paradigm shift has to come in here. One thing I've heard Bruno say, this isn't CSR, the economics mutuality. It's actually business innovation, right? And for an investor like myself, it's not impact investing. The idea of mutuality is an innovation in the approach to investing. And innovation is, I don't know if this has been used, Bruno, but I think of it as three-dimensional capitalism. We always thought of capitalism as being only financial capitalism, but in fact, there's these two other dimensions that I think Catalyst and Mars have now brought forward in a much more pointed way than I've ever seen. And that three-dimensional capitalism is actually an innovation in thinking for investors. And it delivers better results. It makes you more effective in the markets to understand the importance of the relationships, for example. And I hope that not only us in this room, but the broader set of investors operating now in these emerging and frontier markets will start to think of this three-dimensional capitalism as the way you have to approach a market like Ethiopia or somewhere in Latin America to be successful.
Quick question: Who would invest in a country like Ethiopia or Mongolia? Out of not that many. Okay, no, that's interesting. I mean, you want to talk to those people?
Yeah, see me after. We'll those of you who didn't raise your hand, I'll get you convinced in no time at all.
Yesterday we talked a lot about metrics. What you can't measure, people don't believe. So it becomes really a belief issue. If you don't have an incentive, and usually an incentive is something that feeds us, be it our ego or our pockets, then it is really difficult to have an idea. But what we do have is a multiple bottom line. So that means that, yes, we have various forms of capital, and Bertrand, I would like you to comment on that as well, where when we have an interest rate environment that is low, a multiple bottom line is something that actually sells the idea, okay, you won't have it every 3 months in terms of your income, but long term, you have various forms of capital and you've got more in terms of complexity of what you get as a return on your investment.
No, I think you have to be, I don't remember who presented the slide yesterday about being simple, not simpler. But the point is you really have to reassure people that their performance is protected, and then you add to that. As Gabriel said, if you start by saying impact or mutuality, people say, oh my God, they are freaking out and say, no, I can't do that. Or you go back to the CSR bucket or the philanthropic bucket or whatever. So you have to reassure people that you are financially sound. And then you say, guess what? On top of that, you will do great things. And probably if we do great things, I might be able to demonstrate that by doing great things, even your performance will be better. But it cannot be the other way around. In today's world, people are so stressed. They are very risk adverse after what they've been through in the past 10 years. So they cannot be risk adverse forever, but they can be risk adverse for a long period. So you have to reassure them and say, no, it's under control. Performance, and what you have to address is also a perception issue. When I presented my product, first time I presented my product to a family office in New York 2 weeks ago. So the idea is, again, to mobilize institutional money into sustainable development in Latin America and say, okay, can you invest in mezzanine debt to finance water project in Brazil or agriculture project in Colombia, whatever. So it's not totally simple. And the guys say, oh, I like your ideas, etc. But my clients, so the rich family behind me, they will say, okay, emerging market, I need this. Oh, it's innovative, I need this. Oh, mezzanine, that's complex, I need this. And so you say, okay, it doesn't work. And then you have to say, but you know, this perception issue, it does matter. I mean, I cannot ignore that because if the guy doesn't want to move because of perception, he will not move. End of the story. So I have to try to address that. And that's why, coming back to my point on public money and public influence, that's why I'd like to partner with a public bank that can mitigate part of that risk. And then you can move down. Oh, okay, oh, these guys can do that, do that. Oh, so we are back in kind of chartered territory as opposed to uncharted territory. But you cannot bypass that. Make sure they got their performance. If you're a pension fund, you're paid to pay the pension. You're not paid to please whoever in the world.
Mike, you are looking more to partner with people that are aligned right from the start rather than to convince through a very lengthy process in your sales pitch. How do you find, alignment is, I think, fundamental to really change also the way our financial system is supposed to work in future.
Absolutely, and that's why when we are looking to hire and we bring people on, we're very careful about what are the motivations of the heart and why are people doing what they're doing, because that's kind of the base side. When I first started Chatham, which was 26 years ago, we located outside of Philadelphia in a very small town. And I was told at the time, no, Mike, if you're going to do a derivatives advisory shop, you have to be in New York, London, or Hong Kong. And I'm like, well, maybe not. Let me try. And the reason it really worked there is because what we did is we said, look, let's try to hire really, really smart people that can learn this, or smart people that are trustworthy. Because it's easier to teach really smart people, really trustworthy people, it's easier to teach them derivatives than it is to actually just have a derivatives person and teach them how to be trustworthy. So we went the other way, and so I'm not saying all derivatives people are not trustworthy, okay? There's good derivatives people who are trustworthy, but it's a problem. So that's the way we went. The first hire that we had that had any derivatives background besides myself was probably close to 10 years in. We just didn't hire off the street. We hired people that really believed in these concepts, and that really formed the basis of our company. But if I can just say, in the convincing thing, because I have this conversation again, coming from the investment banking, finance, sales, and trading. The mentality is arbitrage, zero-sum game, yes. Right? So if you are doing good, obviously that immediately cuts profit. Okay, and I've thought a lot about this and say, how do you actually challenge that? And I read a book years ago. It was a Stephen Covey book called The Speed of Trust, which really just helped crystallize some of these things. But he talks in there about trust taxes and trust dividends. And really what I believe is going on and why because we've been very successful financially. But the reason is because what's happened is in any non-trusted industry, and finance has got an abundance of that, especially since 2009, the tax that our industry is paying, just look at 22,000 pages of Dodd-Frank, the tax that our industry is paying for the lack of trust is enormous. And so what we're doing is we're essentially, if you can say, our profit is in a way, because we've got these trusted relationships, we are able to kind of get back some of those trust taxes.
You just mentioned regulation, Dodd-Frank. Do we need more regulation to get people more, good as investors, good as in people representing the financial sector? What do you think? Is that the way forward? That's an open question. Who does think, okay, that's worded. Who thinks that regulation is always the way to get people to do the right thing?
Yeah, but you cannot ignore...
Okay, it was a leading question.
I spend a lot of time, because I've been a regulator too. For the last 3 years, I was a member of the Financial Stability Board chaired by Mark Carney, actually, who is an ex-student of Oxford. And we discussed that a lot. You need regulation. So it's not one or the other. It's not sufficient, but you need a good regulation. You need good supervisors. It's not good enough to have a code. You need cops and radars to make sure people respect the code. And then on top of that, you need to work on the behavior of people. And that starts here.
But isn't that the point? Because regulation always brings up the super smart to, overcome regulation.
Let me share with you an anecdote, which is, it was in December 2008. I was invited to speak with a financial institution practice of a leading consulting firm. We will not give the name, but very leading consulting firm. And they say, Bertrand, do you think we should address the compensation problem in banks and trading floors, etc.? I say yes. And then they laughed and say, well, you're ridiculous. This cannot be discussed. The guys are big enough to discuss their compensation scheme, etc. I say, believe me, if we are incapable together to self-regulate, the legislator will step in and it's going to be painful. And guess what? Bankers is the only population in Europe whose compensation is regulated by the European directive. So at some stage, if you really don't behave, then the regulators step in. So it must work both ways.
So it's a question about reward and incentives as well, how you behave, right?
Yeah.
I also think we can't get away from the fact that people are, look, the fundamental basis for capitalism, that we all pursue our own self-interest, right? And I think part of what makes the economics of mutuality powerful is we can change the definition of self-interest. You can achieve your self-interest through caring about human capital, through caring about social capital, through caring about natural capital. That's actually in your self-interest. And if we could get that ingrained into the thinking, well, great, everyone can be selfish, and they'll actually realize that the best way to be selfish is to make sure that social capital and human capital are taken care of, because actually that's going to get you to a better place. And I think if we try to fight the fact that we're all a bunch of selfish, broken people, we're never going to succeed, right? We also can't regulate our way out of that because we're smart and selfish and broken. And if you're smart enough, you figure out how to get around it. But you have to say, how do we actually change the incentives so that the incentive to help yourself is actually an incentive that's positive for the other pieces of the puzzle?
So it really, go ahead, Mark.
I was going to say, to Gabriel's point, regulation, clearly it's needed. Through the financial crisis where we sat, we saw a lot of things that just weren't right. Not illegal, but not right. But the problem is regulation is always solving last year's problem, last decade's problems. So we've got thousands of pages of regulation, and it's really solved a 2009 problem. It's not going to solve a 2019 problem. And I don't know what that next crisis is. But the thing is, it's essentially what feels to me is the more regulation there is, it puts a higher and higher premium on the smartest and most innovative minds, and really pulls minds to arbitraging regulations. And so what you're doing is, if you talk about income inequality, that doesn't help, because what you're really doing is being able to have the smartest minds exploit it, and there's a lot of money in being able to exploit those regulations.
So I think coming back also to what Gabriel said earlier on, and that is that the approach to investing, what is a good investor? Let's define the responsibility of a good investor. What is a good investment? You know, all these smart guys on Wall Street and wherever they sit, developing these wonderful financial products, if they have a different approach and see, and then we have a longevity there in the actual concept of what mutuality could be in finance. I think it's time to open up the discussion to everybody in the room yet again. I'm going to join you yet again and see, because you know, finance is really, really tough to deal with and to calm your mind around with. And at the end of the day, because it's a bit like, you know, going to the hairdresser, your money is extremely close to you and you don't want to have messed around with. Please, the lady up there. Can you use the mic? Sorry. Thank you.
Very much. Morning, I'm Valerie. Thank you so much to the panel for giving these very rich and different insights into what is a complex system which cannot be disconnected from the society because it's intertwined actually with society. And actually, you mentioned, Michael, the fact that these people living in the financial system sometimes have a narrow view, or, you know, that's my maybe, okay. I mean, misinterpreted what you're saying, but they tend to focus on something, and it's kind of silo thinking in a way. And my question to you, perhaps, is how can we open up the minds of the financiers? Mm-hmm.
It comes down to, I think, first and foremost, which is a really tough topic, it's compensation. Because essentially within Matt Levine, who writes for Bloomberg, and he's brilliant, I love his column, but he once said that formulas and incentives are like an evil genie. They give you exactly what you want, but they take you very literally. And that's kind of what happens. We have compensation systems that reward very specific metrics. Now, and people are extremely good at delivering those metrics. But nobody looks outside and says, what are the ripple effects of those metrics when taken holistically? Personally, I believe that if back in the CLO and CDO and alt CDO squared and everything that was happening back in the 2000s, if all banks and if the compensation plan was that everyone had to buy, or their entire bonus was in B pieces that were basically paid out over the next decade, we would have never had a financial crisis. But what happened is everyone was able to front load their comp, and the risk was backloaded. And it was an extremely efficient system. We got exactly what we built it for. But in my view, the compensation system is really the driver of it. By the way, I don't know the answer to how to change it to make it work. I haven't seen one that I actually like. So I'm raising the problem. I am definitely not providing the solution.
Another question down there, please. Yeah. Just 2 minutes for the mic. Thank you.
I'm wondering, because a lot of the financial products their value is based on what the market predicts, and it's hard to control the market, but there's ways to influence it. And the question is, how can we put, this mutuality to input it in the market so that they value companies that are mutual? Because the markets are at the end of the day, are the ones that are going to decide what's worthwhile or not.
But who drives the markets? Sorry, Who drives the markets? I do understand your question, so I wanted to interject. Yeah. But who drives the market? Just think about that as well. Sorry. Who would like to pick up?
I'll take that to at least some extent. I think about things from a private markets perspective, because we do private equity and private debt, which is a little bit different because we're not having to look at sort of public market responses day in and day out. And I'll tell you that in my view and my experience, the other areas of capital within the economics mutuality actually are valued by buyers. So when we, of course, buy a company, we look to sell it eventually. And when it comes time for that valuation, of course, the, let's say, biggest chunk of the valuation that the buyer is willing to pay is just going to be on the financial metrics. But very, very often, well, I would say all the time in our experience, there's also a degree to which premiums or discounts are applied based on those other areas of capital. So for example, how good is the workforce? How happy are they? How stable are they, right? To what degree is that particular business secure in its community? The buyer's going to come and visit, and he's going to look around, or she's going to look around and make a determination as to whether this business is sustainable, whether the community likes it there. If it doesn't like the business there, then there's going to be some discount on the value that the buyer's willing to pay. And I think that's something we need to, again, remind ourselves of and start talking about more, is that these sort of things do actually add value to the eventual price that asset can be sold for, particularly if we're intentional about it and if we communicate, I think, also about it in the process.
If I may just add, coming back to my $100 trillion figure, there is also something which is worth $100 trillion. It is the money managed by institutional investors, pension funds, asset managers, life insurers, etc. So on the one hand, it's scary. You say, my God, so much money in so little hands, they can do crazy things. And I've heard that, and it's a possibility. But you can also play the flip side and say, well, maybe so much money in so few hands, if these hands are educated and understand what's going on, or coming back to my point, even if they don't like it, but their clients like it, these guys can have a tremendous influence on the market. So I think we should really play on that. And what gives me comfort, or relative comfort, again, we are not there yet, is what happened around climate change. It's very interesting. Part of the success of COP21, I hope it will not be changed in the coming weeks or months, is there were several things. So first of all, of course, the French diplomacy, Cocorico, one point, but you also had the Chinese-American handshake, that helps. You had Bill Gates and Mark Zuckerberg pushing for R&D, but you also had, and I think it was very important, a coalition of investors saying it is important. We want to commit to, the principles behind climate change. And when you have 10, 12, 20, $30 trillion, we say, okay, starting now, I just don't want to do this anymore. I want to put my money there and there. That is the difference. So I think, again, it's a starting point. It does not encompass everything we are discussing, but we have to put pressure on these people. And one of the good side of finance is that people copy each other. So if you have, sometimes to do stupid things, but sometimes to do good things. So if some of the leaders in that space start to move, the BlackRock of this world, the CalPERS of this world, etc. With 20 names, you got 30 or 40 billion. These guys can influence the market. At the end of the day, they are the end buyers of all this. So I don't say it's done. I say we have this window now where people have to think smart, and it might shut soon, but we have to push there. And this money is not their money, it's ours.
Mm-hmm. The gentleman here, and then the lady. Just here. Megan, or whoever. Well, that gentleman as well. Another gentleman, then the lady.
This whole thing seems to be around the integrity of leadership. If the leader of the organization does not have integrity, does not have values, I don't think people will follow them. And what I'm interested to know is, how do you create in your own organization people who share your purpose, share your vision? And have you seen over the last 5 or 10 years nicer people running organizations who basically have humility? Because I think the leadership we're looking for in the future is humility and the honesty that we haven't got the answers.
Thank you. Who would like to pick up on this one?
Mike's built by reputation, Mike's built an organization that I think encompasses a lot of what you're saying, so I think you should answer that.
Smooth.
He's too humble to answer.
As I said in the beginning, I'm very passionate about these concepts, and I care very deeply about building a company of purpose and a company that is actually able to make an impact in the markets that we serve. And so I'm passionate about that. But as we've gotten larger, we're close to 500 people, and we have 6 offices on 4 continents. And it's hard. It's really, really hard to keep it there. I spend a good deal of my time on what we call DNA transfer. It's like, how do we produce the content, and how do we make sure that this is going to further and further generations? We've also, fortunately, we're 100% internally owned, which again, it gets back to some of the discussions about ownership and the ability to control that destiny. But we've adopted something that we call stock stewardship. And it's really that you as the equity holder, it's not the returns, everything is not really about you, but you're stewarding it for our purposes, and you're stewarding it for future generations, as I say, for Chathamites, which we call ourselves, that are still in primary school. Okay, and how are we stewarding what we have for the future? And so people that are buying in to stock, this is all part of the discussion, which is it's not just there for you to make a lot of money and then sell out. And so don't expect the big exit, and that's not why you're buying in. But it's hard, and I tell you, every year I just say, I don't know if we can hold it together.
Can I say just one thing on that, which is good leadership, raising up good leadership requires good leadership to raise up that good leadership. I mean, I think if you have a lousy leader at the top who doesn't actually hold the right values, you're not going to end up having anyone else in that organization that at least consistently
Well, you're not going to hire in the first place certain people that are not aligned with your vision.
Absolutely, and that's why I think you have to look, particularly when it comes to investing, right? You have to look at ultimately not just the company's value, but the company's culture. And people talk about that all the time, and yet that is actually essential. And you know, I tell you, for me, I quote unquote waste a lot of time on company culture, on what our people actually think and feel about their job, not just what they're doing to make more money in their job. And I've had people on my team, like one guy in particular said to me, look, I have to be honest, I think you're wasting your time. Like, there's other things that are much more valuable uses of your time, Gabriel. And I said, well, I happen to disagree, because I think raising up the right type of leaders is actually the most important thing one can do in the long run, but it takes time, a lot of time, and a lot of commitment, just like Mike said.
Thank you. Gentleman just down here, and then we come to the lady over there.
Hello. Yeah, thank you. So my question is to the entire panel and to Gabriel in particular. There's a lot being written about frontier markets, and I guess a lot of our MBA students will also work in some capacity in future in emerging or in frontier markets. So how does the notion or the argument of mutuality apply to frontier markets? Are you talking specifically about mutuality with governments? Or are you talking about mutuality when providing funds to companies in the primary markets? So that's my first question. And second question is, what exactly are you doing in North Korea?
Well, we could have a separate forum on that subject. But on the first point first, and maybe last too, but on the first point, I think the idea of mutuality in frontier markets, in my view, it's no different than mutuality anywhere else, but actually in some ways it's more obvious, I think, when you go into a frontier market. Because when you go into a community that is in need, frankly, in many of these markets, right, you have higher rates of poverty, you have institutional problems, challenges, there are often some environmental issues that are creeping up on the edges. The human capital is often lacking in training, education. There's a whole bunch of things you can address, right? So the actual ability to walk out economics of mutuality, to implement it, I guess you might say, I think is in fact very obvious in frontier markets, where it's sometimes less obvious in, say, a developed market context. So for us at Schulze Global, the main idea is to make sure that our team, that everyone who's working within the organization is thinking in that paradigm, right? When we go into a country or a particular company, we're thinking, how do we not only maximize the financial capital, but how do we make sure we're engaging the social capital, human capital, natural capital issues in a way that moves them the right direction to the benefit, eventually, of the financial return, but also to the benefit of the community and country. And I think, again, in frontier markets, there's a huge amount that capital can do, not just providing that liquidity, but providing the influence to make real progress in those other areas of mutuality.
Well-
And that's how we look at it.
Well, you actually put demands on the companies, on the partnerships.
Oh, absolutely. That's part of the deal. If you're going to hand someone, what, $10 million, you can tell them to do a lot of stuff, and they're going to listen to you. I mean, you can say, look, I'd love to give you this $10 million sitting right here, but you're going to need to do A, B, and C, and they will every single time agree. It's amazing. They always agree, and then
Incentives.
you stay on top of them to do it, right?
Very good. The lady over there, thank you.
Yeah. No, for the record, I should
Thanks
clarify
for
that we are not currently engaged in any business in North Korea. We did spend a number of years pursuing opportunities there, and it was an incredible experience. We made money. We also, I think, God willing, made a positive impact. I love that country, and I have a lot of great friends there, and I worry about the situation now. But I pray that we will see a good resolution, and I hope that we're going to have a lot more investors in the future in a North Korea that's prosperous, and I think there's huge potential and wonderful people, and it's a very sad situation. So be praying for that country and all the leaders in the various countries that are involved.
Thanks for picking that up. Thank you. The lady over there. Finally, we get to you.
Hi. So just returning to some of the earlier comments, and yesterday actually we heard Loic from Royal Canin talk about the trouble with new managers who don't immediately see the profitability in the vet and breeder channels. As an institutional investor, I can do what I can do to diligence my managers, excuse me, particularly private equity or mezz debt, right? Looking for managers who believe and support the types of things I care about and who will invest in companies that I care about. And yet, we struggle on exit. How do we maintain confidence in the strategic or the acquirer that the things we care most about will remain and not be stripped in the interest of broadening margins? And as an institutional impact investor who's been at this for 20 years, I think one of the challenges for us is that the moment that we are financially successful, meaning the very moment that returns our capital, we are most exposed around the other capitals we care most about. And would be interested, probably Gabriel in particular, but in the panel's comments on how we think more strategically about exit.
I think, first of all, it's very good that you're even thinking that, because many people get so focused on the sort of the phase that you're in that you forget that none of that really matters if it doesn't sustain after you exit. I think a big part of that, in our view, is making sure that what you implement in these, let's say, other areas, the mutuality principles, that has to actually become part of the DNA of the firm that you've invested in. So up front, you may twist their arm behind their back and bribe them with $10 million to do something positive, but actually over the course of your hold period, which in private equity can be 4, 6, sometimes even 8 years, like over that time, if you do a good job, frankly, if you do even a halfway decent job, you'd better be able to implant a lot of that into the actual management of the company and even the other shareholders themselves, right? So when you leave that company and the capital that you've invested, it exits essentially. The values, the concepts, this whole idea of mutuality, that should be, if you've done your job as an investor and as a manager, look, we're a manager, right? We've done our job as a manager and you've done your job to make sure that we've done our job. We should have companies that, without us at the table, still have that deeply built into how they run their business. And the new acquirer, yes, they could strip everything, but it would be a bunch of work for them to actually turn around what has become part of the culture of that company, right? Part of the culture of that business. And I know you can say, well, it's easy, we'll just cut and chop and the buyer can do all sorts of things. Look, I don't know if there's any way around that, except that if the good people at the top of that organization, the company itself, if they believe in this, they're going to leave. And if your buyer, if the person who buys you, the exit, right? If your exit loses your top management in that company they've just bought, that's going to be a price they're probably not willing to pay. So again, if you have the right values ingrained into the people themselves at the top of these companies, I think you can create some level of sustainability even after your capital exits. But it's not a silver bullet. I don't know if you...
No, I think you said it all. It's also part of the culture that we discuss. I mean, it's really making sure that everything we discuss is not given and we require effort over time. And at some cost as well. Again, I mean, the cost of building the ecosystem of measurement, the cost of building the ecosystem of rating, of people going on the ground to see whether things are done properly, etc. But we built that ecosystem for the previous phase of capitalism, so we should be able to build this ecosystem for the next phase. And it comes with cost, but I'm pretty sure this will also be a cost that pays off at some stage.
But also, the reason you've probably had a bad experience is because I think a lot of managers are full of crap when it comes to impact investing. I mean, you know this. You go to conferences, everyone puts on their impact investing T-shirt because people like you are walking around with capital for impact investors, right? And then as soon as they leave, they take off the T-shirt, and lo and behold, the companies that they invest in don't end up being endowed with these things that we care about. And so I think when impact investors look to managers, they have to look at the values and the approach that those managers take, almost the soft side of what those managers do. And I think a lot of managers are just playing a game with their quote-unquote impact investing, frankly.
To a point where when I first started my idea, I wanted to be put in the impact box. And one of the large investors said, Bertrand, don't do that. Don't do that. Call it whatever you want, but we are done with impact. We're okay with the principles, but we are done with that.
Fantastic. I think the main takeaway here really is that the financial system does have a responsibility and is ultimately driven by people, and people are driven by their values, and the responsibility of the financial sector to transpire mutuality, and that there is more capital than just the financial capital, i.e. also more return on that, is very important. So thank you so much. Thank you again for the engagement.